Introduction to Investment. The introduction of Guide to Investment establishes the importance of investing as a way to build and protect wealth over time. Stanyer begins by discussing the rationale behind investing, explaining that effective investment strategies can help individuals grow their wealth, achieve financial independence, and secure a stable future. Investing is not simply about chasing high returns, but about making thoughtful decisions that align with one's financial goals and risk tolerance. 1. Understanding investment and wealth accumulation. Stanyer elaborates on the basics of investing and wealth accumulation, emphasizing the importance of understanding core financial principles before diving into specific investment strategies. He argues that long-term financial success is based on understanding a few key concepts. The power of compound interest. This fundamental principle highlights how reinvesting earnings allows investments to grow exponentially over time. Stanyer explains the mathematics behind compounding and illustrates how even modest returns can result in substantial wealth when given enough time. Inflation and real returns. He introduces inflation as an often overlooked aspect of investing. Inflation erodes the purchasing power of money, so investors must seek returns that outpace inflation to preserve their wealth. Stanyer discusses the importance of real returns, which take inflation into account. Investment versus speculation. Stanyer distinguishes between genuine long-term investing and short-term speculation. While investing focuses on gradual wealth accumulation, speculation involves taking high risks with the hope of quick profits. He warns against speculative behavior that can result in significant losses. 2. The importance of asset allocation. In this section, Stanyer explains how proper asset allocation, the process of dividing investments among different asset classes, plays a crucial role in managing risk and achieving investment goals. Each asset class behaves differently, and spreading investments across multiple classes helps to mitigate risk. Equities stocks. Stanyer introduces equities as one of the primary asset classes. Stocks represent ownership in a company, and historically, they have offered the highest returns among asset classes. However, stocks are also the most volatile, subject to market fluctuations and economic changes. Stanyer outlines key points. Types of stocks. The book explains the differences between growth stocks, value stocks, and dividend-paying stocks. Growth stocks offer higher potential returns, but come with higher risk, while value stocks are typically more stable. Equity markets and indices. Stanyer introduces stock market indices like the S&P 500 and FTSE 100, explaining how these indices provide benchmarks for market performance. Passive investing strategies often use these indices to capture broad market returns. B. Bonds. Fixed income. Bonds are another key asset class. Bonds are essentially loans made to governments or corporations, and they offer fixed interest payments over time. Bonds tend to be less volatile than stocks, making them attractive for risk-averse investors. Government bonds versus corporate bonds. Stanyer discusses the differences between government bonds, which are typically seen as safer but lower yielding, and corporate bonds, which offer higher yields but come with greater risk. Duration and interest rates. The book explores how bond prices fluctuate in response to interest rate changes. Long-term bonds are more sensitive to interest rate movements, which can significantly affect their value. C. Real estate. Stanyer examines real estate as an investment class, emphasizing its potential for providing income through rent and capital appreciation through rising property values. Real estate can be an excellent way to diversify a portfolio, especially through investment vehicles like real estate investment trusts (REITs). D. Commodities. Commodities, such as gold, oil, and agricultural products, provide a hedge against inflation and diversification benefits. However, commodities can be volatile due to their sensitivity to geopolitical events and supply-demand dynamics. E. Alternative investments. The book touches on alternative investments like private equity, hedge funds, and cryptocurrencies. These investments can offer high returns, but typically involve more risk and require greater expertise. 3. Risk management and the role of diversification. Risk is an inherent part of investing, and Stanyer stresses the importance of understanding and managing it. Diversification, spreading investments across multiple asset classes, is a key strategy for mitigating risk. Types of risks. Stanyer identifies various types of investment risks, including market risk, the risk that the entire market will decline, affecting all asset classes; credit risk, the risk that a borrower, such as a corporation issuing bonds, will default on payments; liquidity risk, the risk that an investor won't be able to sell an asset quickly without affecting its price; inflation risk, the risk that inflation will erode the real value of returns; systematic versus unsystematic risk. Stanyer distinguishes between systematic risk, which affects the entire market, and unsystematic risk, which is specific to a company or industry. Diversification can help mitigate unsystematic risk. Correlation and diversification. The book explores how diversification reduces risk by investing in assets that don't move in tandem. When one asset class performs poorly, others may perform well, providing a buffer against losses. 4. Investment strategies and styles. Stanyer covers different investment strategies, allowing investors to tailor their approach based on goals, risk tolerance, and time horizon. Passive investing indexing. Stanyer highlights passive investing as one of the most straightforward strategies. Investors buy a broad market index, such as the S&P 500, and hold it for the long term. Passive investing is low cost and has historically outperformed most active management strategies. B. Active investing. Active investing involves selecting individual stocks or bonds in an attempt to outperform the market. Stanyer warns that this strategy requires skill and can result in higher fees and greater risk. He provides examples of popular active strategies. Value investing. Investors seek undervalued stocks that are trading for less than their intrinsic value. This strategy, popularized by Warren Buffett, focuses on finding bargains in the market. Growth investing. Investors focus on companies with strong growth potential, even if their current valuation is high. This approach targets high returns, but comes with more risk. Contrarian investing. Contrarian investors buy assets that are currently out of favor with the market, expecting a future reversal in price. C. Income investing. Stanyer discusses income investing, which focuses on generating steady income through dividends and interest payments. This strategy appeals to retirees and others seeking stable cash flow. 5. Behavioral finance and emotional discipline. Behavioral finance explores how psychological factors impact investment decisions. Stanyer highlights how emotions like fear, greed, and overconfidence can lead to poor investment choices. Fear and greed. Investors often make irrational decisions based on short-term market movements, selling in panic during downturns and buying in euphoria during bull markets. Herd mentality. Stanyer discusses how following the crowd can lead to poor investment outcomes. Successful investors must learn to stay calm during market volatility and stick to their long-term plan. Overconfidence bias. Many investors believe they can outperform the market, leading to excessive risk-taking. Stanyer warns against this bias and recommends humility in investment decisions. 6. The role of costs and fees in investment success. One of the most important yet often overlooked aspects of investing is the cost of managing a portfolio. Stanyer emphasizes how high fees and costs can significantly erode long-term returns. Management fees. Actively managed funds typically charge higher fees than passive funds, and Stanyer argues that these fees can eat into returns, especially when compounded over time. Trading costs. Frequent buying and selling generate transaction costs that reduce the overall return on investments. Expense ratios. Stanyer advises investors to carefully examine the expense ratios of mutual funds and exchange-traded funds (ETFs), as even a small percentage difference can have a significant impact over the long term. 7. Building and maintaining a portfolio. In this section, Stanyer walks readers through the process of constructing a balanced investment portfolio that aligns with their goals, risk tolerance, and time horizon. Setting financial goals. The first step in building a portfolio is defining financial objectives, such as saving for retirement, buying a house, or funding education. Risk tolerance. Stanyer emphasizes the importance of understanding one's own risk tolerance. Younger investors may be able to take more risk, while those closer to retirement may prefer safer investments. Asset allocation and rebalancing. Once a portfolio is constructed, Stanyer discusses the importance of periodically rebalancing to maintain the desired allocation of stocks, bonds, and other assets. He also covers how to adjust asset allocation as life circumstances change. Setting financial goals. The first step in building a portfolio is defining financial objectives, such as saving for retirement, buying a house, or funding education. Risk tolerance. Stanyer emphasizes the importance of understanding one's own risk tolerance. Younger investors may be able to take more risk, while those closer to retirement may prefer safer investments. Asset allocation and rebalancing. Once a portfolio is constructed, Stanyer discusses the importance of periodically rebalancing to maintain the desired allocation of stocks, bonds, and other assets. He also covers how to adjust asset allocation as life circumstances change. Tax considerations. The book touches on the impact of taxes on investment returns, offering strategies for minimizing tax liability, such as using tax-advantaged accounts. Conclusion. Staying the course. Stanyer concludes by reiterating the importance of a long-term approach to investing. He encourages readers to remain patient, avoid emotional decision-making, and stay disciplined in executing their investment plan. While market volatility and uncertainty are inevitable, sticking to a well-thought-out strategy will ultimately lead to financial success.